in both directions. If, like Liz says, and what I think is ultimately going to happen, is that you start to see a diminishing and deceleration of the large cap stock EPS. You're going to have some fear, Scott, and people are going to act on that. That's kind of number one. Number two, it also says that you have more corrections during an earnings-driven market, and we've been saying that we're going to have some sort of a correction. I don't think it's going to be quite a bear market, but to the tune of 5 to 10% heading into the fall. And then we finally have our broadening out theme. I still am a big believer in the broadening out theme, and I think that's what's going to really drive things into 2027.
Why would we have a correction? You mean like earnings are not going to live up to the moment, and that's going to cause the correction? So there's got to be a mechanism, theoretically.
So if you think about how great the earnings have been, and Liz nailed it when she said, if it's any kind of blush of any kind of change in tone for management, if they go from a 30% gain in earnings down to 20%, that's a big delta, even though 20% is an amazing earnings gain, but that's going to scare people enough to sell. The other thing, too, is that what was lost in what she said was very, very important. When you run money in portfolios, you can either let your portfolio drift with the market, or you set your back to your original weights. I think it's going to be very, very important over the next 4 to 6 weeks to set back to the original weight, especially considering how far stocks have gone. You've got some stocks that have doubled and now are bigger in weight than some of the Mag 7s in your portfolio, and that's a problem.
You feel like when you look at a snowflake go up 40% in a day, or the microns, you know, these moves, as I've described them, used to be special. You know, you'd see this once, who knows, a few years for a name. Now they're becoming routine.
And that's a problem. That's a problem because now we're becoming used to it. And anytime in the market you get used to it, you get lazy, and that's where we could see that correction beginning to reverse, and that could really spew more downside.
What's going to push money towards the other parts of the market? Is it have to be the end of the war? Oil has to come down? Yields have to come down even further?
Here's an effective tool, right, for the company to raise money and to get the price up. But the long-term effect of an overpriced stock, let's just say, for example, forget that it's SpaceX. Let's talk about any stock that's trading at 100 times revenues. If it comes down to earth, there's going to be a lot of pain. The metaphors are too bad there since we're talking about a rocket ship company. So we're not talking about that company. But a mispriced stock is not in the long-term benefit of a company. And I would bet that Anthropic is looking at that maybe price discovery is something that they want. Surely they want a stock price that's going to go up and do well for the insiders and the investors. But a short-term overpriced stock is not going to help anybody. I'll also say that Anthropic might end up being a much bigger deal. This company could be on pace to be $100 billion in revenues by the end of this year. So if it's priced at 10 times revenues and doing $100 billion in revenues, these are projections, we just don't know the numbers. But if it's doing $100 billion a year and priced at 10 times revenues at the end of the year, that'd be a $1 trillion IPO right there. And my guess is it's not going to be priced at 100 times revenues as SpaceX was, but it's growing faster than SpaceX. We've heard reports that it's profitable, unlike SpaceX. So we can guess how big the business for satellite phones that you have to use outdoors and rocket ships might be. But there are more guesses about the size of the AI business. And what we see right now is that Claude and Mythos and Fable are the leading models in all of AI, a place that the tens of billions of dollars, hundreds of billions of dollars are being spent. These are the leaders. It's growing the fastest. It's maybe profitable. It could be looking at $100 billion in revenues. So this could be a really big deal, regardless how much stock they put out there. But yeah, the tools are on the table to put out very small amount of stock just to get the price up.
And in addition to being a leader in the space, Anthropic also already has strategic backing from two huge names in mega cap tech, in Amazon and Alphabet. So how does that change the investment story here compared to, say, a SpaceX or a traditional IPO?
I don't know that it does. SpaceX also had the backing of companies like Google. So and a lot of the biggest VCs in the world and a lot of private investors as well. So I don't know that it changes anything here. But yes, this Anthropic has got the biggest backers in the world right now, and the company is really going through some spectacular growth right now. There's so much change happening in the world of AI on a just week to week, even day to day basis. I mean, Anthropic's best product ever was illegal on Friday and is legal today. And here you have the company looking into an IPO, a product, their latest large language model that they put billions into building and does some pretty incredible things based on those of us who were able to use it for the short period of time it was out there legally. So there's so much change in this industry, and it's been interesting to see Anthropic, which is right down the street here in San Francisco, come out as a leader really in the last couple of years. And I think the other thing that's really interesting here is that this business of Anthropic is not driven just by its users, but it's driven by essentially robots, these AI agents that we're starting to hear of. Who knows how big that market is? I know that sounds like a ridiculous thing that an oil and gas promoter might say. Like, who knows how much oil's under the ground, under my foot? I can't even tell you to buy these shares. I'm not recommending any investments in Anthropic or anything else, but it's a really interesting business when you have robots building robots that are going to be using these tools that have sort of an unseen number of use cases and user numbers. It's really incredible. It's going to be a fun IPO to look at. We read IPO research at Epistrophe Capital Research increasingly, and I can't wait to get my hands on this.
Wall Street may be underestimating Nvidia again. Something doesn't add up in the semiconductor market. AI infrastructure spending is accelerating. Demand for computing power continues to exceed the supply. Memory shortages are pushing prices higher. Companies are signing contracts year in advance just to secure critical components. And some of the largest technology companies in the world are preparing to spend hundreds of billions of dollars building AI infrastructure. Yet Nvidia is trading as if the best part of AI boom may already be behind it. That creates an important question. What does the market know that investors don't? Is competition finally catching up? Are customers preparing to reduce their spending? Or has the Wall Street become so focused on everything that could go wrong that it is ignoring what is still happening right now? Because when you look across the semiconductor supply chain, the evidence suggests this AI infrastructure cycle may be far from the finish. The market is searching for the end. Every major investment cycle eventually reaches the same point. Investors stop asking how big the opportunity can become and start asking when it will collapse. That's exactly where the AI trade is today. How much longer can hyperscalers keep spending? When will the new supply arrive? And will the custom chips replace Nvidia GPUs? Can memory prices remain this high? Will AI companies generate enough revenue to justify trillions of dollars investment? These are the legitimate questions. But here is the one major problem. The companies actually building AI infrastructure still aren't behaving like demand is slowing. They are behaving like they cannot secure enough capacity, and that distinction matter. The bottleneck keep moving. At the beginning of AI boom, the shortage was GPUs. Companies were waiting months to receive advanced accelerators. Then the bottleneck expanded. Networking equipment became the critical. Power availability became a major constraint. Cooling infrastructure became increasingly important. And now memory has moved directly into the center of the AI investment cycle. This tells us something important. AI demand hasn't disappeared. The pressure is moving from one layer of the infrastructure stack to another. Every time the industry solves the one bottleneck, another one appears. That's what happens when the demand grows faster than the physical infrastructure required to support it. Memory has become strategic. For years, memory was one of the least respected business in the semiconductor industry. Investors use DRM and NAND as commodities. Companies produce too much supply, price collapse, and manufacturers reduce the investment. Demand recovered, and the cycle started again. But AI has introduced a new variable: performance. Modern AI systems require enormous amount of memory bandwidth. The accelerators need access to data quickly. Models are getting larger, and inferences workload are increasing. Context windows are expanding, and the amount of data moving through the AI systems continue to grow. Memory is no longer simply where the information waits. Memory increasingly determines how efficiently AI systems operate. That's why customers are fighting to secure the supply. Micron just gave Wall Street something it's never had. That is visibility.